The Bank of Canada communicated a stance to hold interest rates shifting from a previous dovish stance as it seeks clarity on how US trade policy will affect the Canadian economic outlook. There are many unknown unknowns. The times are unusual with many things we know we do not know, and perhaps even more we do not know that we do not know. Listening to the Bank of Canada Governor Tiff Macklem, he talks about the uncertainty.
Today, Governing Council maintained the policy interest rate at 2.75% following 7 consecutive cuts. The Canadian economy ended 2024 in good shape. Inflation had been close to the 2% target since last summer. The substantial interest rate reductions since last spring had boosted household spending, economic growth had picked up, and many businesses were telling us the economy had renewed momentum. Since then, the dramatic protectionist shift in U.S. trade policy and the chaotic delivery have increased uncertainty, roiled financial markets, diminished global growth prospects, and increased inflation expectations. The path for U.S. trade policy remains highly unpredictable. We still do not know what tariffs will be imposed, whether they'll be reduced or escalated, and how long all of this will last. At this meeting, we decided to hold our policy interest rate unchanged as we gain more information about both the path forward for U.S. tariffs and their impacts. Monetary policy cannot resolve trade uncertainty or offset the impacts of a trade war.
Hello and welcome to Global Business Insights, where we bring you more depth on the latest business headlines, and thank you very much for your time. As central banks continue to navigate a terrain of many unknowns by pausing for clarity, one thing that is known is that US tariffs are highly likely to generate a temporary rise in inflation. According to Jerome Powell, he says his job is to ensure it stays transitory, that's inflation, and not a problem for their long-term target of stability. Let's listen to Powell at the Economic Club of Chicago yesterday.
Thank you and good afternoon. So, at the Fed, we are always focused on the dual mandate goals that Congress has given us: maximum employment and stable prices. Despite heightened uncertainty and downside risks, the U.S. economy is still in a solid position. The labor market is at or near maximum employment. Inflation has come down a great deal, but is still running a bit above our 2% objective. Turning briefly to the incoming data, we'll get the initial reading on first quarter GDP in a couple of weeks. The data we have in hand so far suggests that growth has slowed in the first quarter of this year from last year's solid pace. Despite strong motor vehicle sales, overall consumer spending appears to have grown modestly. In addition, strong imports during the first quarter, reflecting attempts by businesses to get ahead of potential tariffs, are expected to weigh on GDP growth. Surveys of households and businesses report a sharp decline in sentiment and elevated uncertainty about the outlook, largely reflecting trade policy concerns. Outside forecasts for the full year are coming down, and for the most part, point to continued slowing, but still positive growth. We are closely tracking incoming data as households and businesses continue to digest these developments. In the labor market, during the first 3 months of this year, non-farm payrolls grew by an average of 150,000 jobs per month. While job growth has slowed relative to last year, the combination of low layoffs and lower labor force growth has kept the unemployment rate in a low and stable range. Meanwhile, the ratio of job openings to unemployed job seekers has remained just above 1, near its pre-pandemic level. Wage growth has continued to moderate while still outpacing inflation. Overall, the labor market appears to be in solid condition and broadly in balance, and is not a significant source of inflationary pressure. As for our price stability mandate, inflation has significantly eased from its pandemic highs of mid-2022 without the kind of painful rise in unemployment that has frequently accompanied efforts to bring down high inflation. Progress on inflation continues at a gradual pace, and recent readings remain above our 2% objective. Estimates based on the most recent data from last week show that total headline PCE prices rose 2.3% over the 12 months ending in March, and that excluding the volatile food and energy categories, core prices rose 2.6%. Looking forward, the new administration is in the process of implementing substantial policy changes in four distinct areas: trade, immigration, fiscal policy, and regulation. These policies are still evolving, and their effects on the economy remain highly uncertain. As we learn more, we will continue to update our assessment. The level of tariff increases announced so far is significantly larger than anticipated, and the same is likely to be true of the economic effects, which will include higher inflation and slower growth. Both survey and market-based measures of near-term inflation expectations have moved up significantly, with survey participants pointing to tariffs. Survey measures of longer-term inflation expectations, for the most part, appear to remain well anchored as well. Market-based break-evens continue to run close to 2%. So, as we gain a better understanding of the policy changes, we'll have a better sense of the implications for the economy and hence for monetary policy. Tariffs are highly likely to generate at least a temporary rise in inflation. The inflationary effects could also be more persistent. Avoiding that outcome will depend on the size of the effects, on how long it takes for them to pass through fully to prices, and ultimately on keeping longer-term inflation expectations well anchored.
Later today, Madame Lagarde of the European Central Bank is expected to cut interest rates for the seventh time in a year to prop up an already struggling economy expecting to be hit from US tariffs. Yesterday, the World Trade Organization forecasted that global trade will fall this year because of US tariffs, adding that the decline is expected to be particularly steep in North America, where trade is seen as dropping by more than a tenth. An acceleration in commercial activity was evident in the latest US retail sales data, as many stepped up purchases, stocking up on goods to avoid being caught by imminent tariffs. US total retail sales rose 1.4% in March, beating the expected 1.3% after rising 0.2% a month earlier. On an annualized basis, sales rose 4.4%, the fastest pace since December 2023, which contrasted with the slowdown in inflation to 2.4% year on year. But American import bookings from China also collapsed by 64% in the week ending April 8th compared to the previous week. As the external front becomes challenging, China is hoping that domestic spending will fill the gap. And another shift observed is Asian governments looking to buy more US oil and gas as they move to lower their trade surplus with Washington in hopes of easing their tariff burdens. In my deep dive, my attention is drawn to an article in the Foreign Affairs Journal yesterday themed The Age of American Unilateralism, in which Michael Beckley, Associate Professor of Political Science at Tufts University, attempts to present a silver lining in what looks like the crisis playing out. He argues that crisis can lead and often leads to opportunity. For example, it was the Civil War that drove rapid expansion of the Northern Railroad network, laying the groundwork for later transcontinental lines. It was the post-World War II environment that led to Bretton Woods and the liberal order which we see today. It was forged then in the heat of rivalry when fear compelled countries to come together. It was also Cold Warfare's, not peacetime consensus that sparked creation of the Interstate Highway System and the National Defense Education Act. And military research and development funded many breakthroughs, including giving rise to the semiconductor industry, the GPS technology, and the internet. One cannot deny that national security concerns have been America's most consistent engine of public investment. A crisis can be a good crisis if it produces positive outcomes that would not have been without the crisis. I must add that cost-benefit analysis of crisis may still reveal that assessment of pains and gains show that those who bear the pains may not agree with others who enjoyed gains. For example, Japanese families still scarred by Hiroshima may not agree that the rise of a highly prosperous post-war Japan in any way justifies the costs. The article argues that demographic shifts and new automation and artificial intelligence are radically changing the demand for foreign labor and how we think about supply chains, as technologies like additive manufacturing or 3D printing and smart logistics are compressing supply chains and not just enabling reshoring, but actually making the value proposition to reshore much more attractive. AI is replacing foreign call centers and increasingly digital and automated factories. Cheap energy and the world's biggest consumer market all implies that US firms may be coming home not just to avoid tariffs or for security, but because it makes business sense. The United States still needs the global economy, but its needs are narrower, much more selective, and easier to disconnect. In other words, the considerations for offshoring have vastly changed. Looking at demography, he argues in his article that the US is the only great power whose prime age workforce is projected to grow throughout this century. So jobs are going to be needed. He adds that by 2050, the workforces of the major economies of Eurasia will lose around 200 million adults aged 25 to 49. That's the legion that drives productivity, military recruitment, and economic growth. And that could begin to fade as more demographic strength shifts to Africa and emerging economies. Still growing prime age workforce in the US means as other economies shrink and strain, the US economy can be more central to global growth and its fiscal base and military manpower more robust in relative terms. China, of course, is rising and becoming even more aggressive geoeconomically. So what does this all mean? The times call for leadership that can digest the context and understand the opportunities in the crisis, or can look beyond the fog to see less obvious dynamics playing out. Crisis can indeed be opportunity, but only if it is made so. Hardly will this happen accidentally or naturally. Visionary leadership that sees far ahead to attain what others don't think is possible or don't even see will make all the difference. Onlookers and spectators will soon be cheering a vastly different age driven by new technology and capabilities. This morning, European markets opened lower as traders await the latest monetary policy decision from the ECB. Asia-Pacific markets mostly rose overnight, breaking ranks with Wall Street, which had seen more selling of tech stocks yesterday after Nvidia disclosed sales of its H20 AI accelerators to China will require a license from the US Department of Commerce. That is one that it's unlikely to get. Selling on Wall Street also picked up after Federal Reserve Chair Jerome Powell sounded hawkish notes. Oil prices extended gains in view of tighter supply after Washington imposed further sanctions to curb Iranian oil trade, while OPEC producers pledged further output cuts to compensate for pumping above agreed quotas. Well, that's it on Global Business Insights. Thanks for watching. This is Bode Oshosani. Bye-bye.